What is capital gains and capital gains tax? A deep dive into tax policy and economic impact. Capital gains represent the increase in the value of an asset, such as stocks, real estate, or other investments, from the time it was purchased to when it is sold. In simpler terms, it's the profit an investor makes when an asset appreciates in value. Capital gains can be a critical source of income for many investors, particularly those who rely on the appreciation of investments as part of their wealth-building strategy. However, these gains are also subject to taxation, commonly referred to as capital gains tax. This article will explore what capital gains are, how capital gains tax works, how tax policy affects these gains over time, and the broader economic implications. Understanding capital gains. Capital gains occur when an asset is sold for more than its purchase price. For example, if you buy a stock for $100 and sell it for $150, the $50 difference is your capital gain. Capital gains can be realized from various assets such as stocks and bonds, real estate, mutual funds, art and collectibles, and cryptocurrencies. Types of capital gains. Short-term capital gains. These are gains from the sale of assets held for 1 year or less. They are typically taxed at the same rate as your ordinary income, the income tax bracket you fall into. Long-term capital gains. These are gains from the sale of assets held for more than 1 year. They are taxed at a lower rate, which is often more favorable to investors. Why the distinction? Governments often encourage long-term investment by taxing long-term capital gains at a lower rate than short-term gains. This policy incentivizes investors to hold assets for extended periods, thus providing greater stability to financial markets and limiting excessive speculation. Capital gains tax, the basics. Capital gains tax is the tax you pay on the profit you make from selling an asset that has appreciated in value. The rate of taxation on these gains depends on several factors, including the duration the asset was held and your income bracket. Tax rates in the U.S. In the U.S., the rates for long-term capital gains tax are 0%, 15%, or 20%, depending on your taxable income. Short-term capital gains, on the other hand, are taxed at the same rate as your ordinary income, which can range from 10% to 37% for federal income tax purposes. State and local taxes may also apply. All right, let's dive into the 2023 capital gains rates for long-term investments. So, here we go, 0%. This rate applies if your taxable income is up to $41,675 for individuals or $83,350 for married couples filing jointly. Next, we have 15%. This rate applies to those earning between $41,676 and $459,750 for individuals, or $83,351 to $517,200 for married couples. Finally, 20%. This rate applies if your taxable income is over $459,750 for individuals, or $517,200 for married couples. Now let's talk about some special cases. Some assets, such as collectibles, think art, antiques, are taxed at a higher rate of 28%, regardless of income levels. Meanwhile, real estate has specific rules like the exclusion of up to $250,000 or $500,000 for married couples of gains from the sale of a primary residence. Finally, let's explore how capital gains tax policy affects investors over time. Tax policy concerning capital gains has shifted over the decades, largely depending on the political and economic climate. The fluctuation in capital gains tax rates impacts both individual investment strategies and broader economic activity. It's fascinating to see how these changes ripple through the financial landscape. Historical shifts in capital gains taxation have been quite significant over the decades. In the 1980s, during the Reagan administration, capital gains taxes were reduced in conjunction with income tax reductions. This was part of a broader supply-side economic policy aimed at stimulating investment and growth. Moving into the 1990s, the Clinton administration initially raised capital gains taxes in the early part of the decade. However, they later reduced them to encourage investment in technology and emerging industries. This period saw a major stock market boom, driven largely by the tech industry. In the 2000s, the Bush administration lowered capital gains taxes again, bringing them to a historical low of 15%. This was intended to further incentivize investments and capital market participation. Then, during the Obama era, in the aftermath of the Great Recession, the administration increased capital gains taxes for high-income earners. This was part of an effort to address budget deficits and fund healthcare reforms. The long-term capital gains rate for high-income earners was raised to 20%, with an additional 3.8% net investment income tax, or NIIT, added for wealthy individuals under the Affordable Care Act. Finally, under the Trump administration, capital gains tax rates remained largely unchanged. However, there were some benefits to high net worth individuals from changes in the way certain investment income was treated. Impact of tax policy on capital gains. Lower capital gains tax rates encourage individuals and institutions to invest in stocks, real estate, and other capital assets. The expectation of favorable tax treatment for long-term investments can promote a healthier economy by encouraging more patient, growth-oriented capital allocation. High capital gains tax rates, particularly on short-term gains, can discourage speculative trading. By imposing a higher tax on short-term transactions, tax policy can nudge investors toward holding assets for longer periods, which often promotes market stability. One issue that often arises from capital gains taxation is the lock-in effect. When taxes on capital gains are high, investors may be disincentivized from selling their assets, even if they would like to reinvest the proceeds elsewhere. This can lead to inefficiencies in the market, as capital is locked in unproductive or underperforming assets. The lower tax rates for capital gains compared to ordinary income can contribute to wealth inequality. High net worth individuals typically derive a significant portion of their income from investments rather than wages, allowing them to benefit from lower tax rates on capital gains. Policymakers often debate whether capital gains should be taxed at the same rate as ordinary income to address this issue. Challenges and criticisms of capital gains tax. One criticism of capital gains tax is that it represents a form of double taxation. Investors are taxed once when they earn the income used to purchase the asset, and again when they sell the asset for a profit. Proponents of lower capital gains taxes argue that this discourages investment and is unfair to those who save and invest for the long term. As discussed earlier, there are new proposals to tax unrealized capital gains, which could fundamentally alter the way investment gains are taxed. Unrealized gains are the increase in value of an asset that has not yet been sold. Historically, taxes are only levied once the asset is sold, realized gains. But taxing unrealized gains would force individuals to pay taxes on the value increase of assets they still hold, creating potential liquidity challenges and other complications. Global comparisons. Different countries tax capital gains in various ways, reflecting their economic priorities and tax philosophies. For example, some European countries have higher capital gains taxes than the United States, while others have tax exemptions for certain long-term investments. The approach a country takes can significantly affect investment flows and economic growth. Conclusion: the broader economic impact. Capital gains taxation plays a critical role in shaping investment strategies, the stock market, and the broader economy. Tax policy not only determines how much investors keep from their gains, but also influences how much risk they are willing to take, and for how long they are willing to hold their investments. Over time, changes in capital gains tax policy can lead to shifts in investor behavior, affecting everything from market liquidity to wealth distribution and the long-term stability of financial markets. While lower capital gains taxes can stimulate investment, they also contribute to wealth inequality. Conversely, higher taxes might curb speculative behavior but could deter investment and lead to inefficiencies like the lock-in effect. As governments continue to search for the optimal balance, the ongoing debate surrounding capital gains tax highlights its importance in both individual financial planning and the broader economy. Understanding how capital gains taxes work and how policy changes affect them is crucial for investors looking to maximize their after-tax returns while navigating the complexities of the tax system. As new proposals and reforms are introduced, it's more important than ever for investors to stay informed and adjust their strategies accordingly.